Hello traders, welcome back to the Forex Geek where we dive deep into the tool that can help you make smarter trading decisions. In today's video, we are going to be talking about the correlation hedging, a strategy that many traders overlook but could be the missing piece in your trading arsenal. You will discover how certain currency pair move in relation to each other and how to use this relationship to protect your position and find new trading opportunities. Let's begin with the fundamentals of currency correlation and build up to the complete trading framework. Now let's start by understanding correlation basics. When you trade forex, you are dealing with pairs that have hidden relationships. Think of currency pairs as dance partners. Some move in perfect harmony while others step on each other's toes. This relationship between pairs is what we call correlation. Currency correlation measures how pair move in relation to each other. A correlation of +100% means two pairs move exactly the same way, while it's -100%, this means that it moves in opposite direction. Then at 0%, there is no relationship at all. Now let's take Euro USD and the GBP USD as prime examples. This pair often shows strong positive correlation because the close economic ties between the Europe and the United Kingdom, they have close economic ties. When Euro USD is rising up, GBP USD is rising up. When it's falling down, when it's going down, GBP USD is coming down. As you can see in the chart, Euro USD is presently coming down now, while GBP USD is currently coming down. Now on the flip side, Euro USD and USD CHF demonstrate negative correlation. Euro USD and USD CHF show negative correlation as seen in the chart. While Euro USD is coming down, USD CHF is going up. They are directly opposite and they demonstrate negative correlation. Now, understanding this relationship gives you a significant advantage. It gives you a significant advantage. To you can use strong to confirm your trade ideas and spot divergence that signal potential trading opportunities. Remember, these correlations aren't fixed, they change over time. Economic condition, interest rates, and global events can all affect how currency pair relate to each other. This dynamic nature is exactly what creates opportunities for correlation hedging strategy we are about to discuss. Now let's discuss the core strategy breakdown. Now that we understand the basics of correlation, here is how to turn this knowledge into a practical trading strategy. First, you identify the correlated pairs such as and we'll be making use of Euro USD and GBP USD for this example. Euro USD and GBP USD show a strong positive correlation, often moving in sync due to their economic connection. Meanwhile, Euro USD and USD CHF demonstrate negative correlation, moving in opposite direction. As seen in the chart, Euro USD is coming to the downside while GBP USD is still moving to the downside. For a position setup, you have two primary approach with positive correlated pairs. Open opposite position to hedge your risk. For example, if you are going long on Euro USD, consider a short position on GBP USD. This creates a natural hedge. When one position faces loss, the other typically gains. So if we are to, let's assume we are trying to take a trade at this area on GBP on Euro USD. If we take a trade at this area, as one goes up, let's assume this has happened or this is happening in real time, we will take an opposite trade. This is a particular area. If you notice, their price action looks similar, so we'll take at this same time, we'll be taking a bearish trade. We'll put our stop loss at the same side, and we'll have a fixed stop loss for both areas. So when price exits or exceeds that area, you will know that the trade isn't going in that direction. This creates a natural hedge. When one position faces loss, the other gains. Now, position sizing is crucial for this strategy. For a standard lot, Euro USD has a peak value of $10 per 10 by 100,000 units. You will need to adjust your position size accordingly to maintain balanced exposure according to your correlated pairs. Here is a practical example. When Euro USD shows signs of declining, you will have to open a short position on the Euro USD, then simultaneously opening a long position on USD CHF because they have negative correlation. Let me quickly open USD CHF to explain what I mean. While we are opening a long position on this pair, if we are opening a short position on this pair at this area, you can equally open a long position on the negative correlated pair of Euro USD, which is the USD CHF. We would buy at this particular area time in price. If you check the time, you will notice this particular trade was taken on a Monday, 25th February 2025. While here, if you go to the same time on the USD, on the Euro USD, you will notice this is still Monday, 24th of February 2025, and you will notice that as the price is going down on the Euro USD, the price is going up on the USD CHF. Your risk is distributed across both pairs. This approach provides protection against market volatility while maintaining profit potential. The key is to monitor your correlation value regularly as they can swiftly change due to market condition. Alright traders, we have come to the end of this video. Engage with us in the comments below. We would want to hear about your experiences. If you found this video helpful, do not forget to like, share and subscribe to our channel. Please turn on your notification bell so that you wouldn't miss out on any of our trading tips and strategy. Thank you for watching, and we will see you in the next video.